Voila. Okay, well, thank you very much. This is, by the way, is joint work with Stephen Utkus at Vanguard. And the motivation for this work is extremely simple. So we know that individual investors are not particularly financially savvy, so when they're left alone, they make a lot of investment mistakes. And we know that financial advisors could potentially help, but we also know that financial advisors are extremely expensive, and we know that they turn out to be sometimes ineffective in helping their customers. So robo-advising could potentially be the answers, right? We could help millions of people and hit them all at the same time. At the same time, we can do it very, very cheaply. And what is actually amazing about this area of fintech is that when you look at the spectrum and when you look at the industry, many of the companies that you see on this slide that are now doing robo-advising, that are doing robo-retirement and digital brokerage, were all companies that 5 or 10 years ago were completely non-existent. So part of the research agenda of mine is exactly going in and understanding what are the pros and cons of some of these tools for investors. So I have a project with 2 other co-authors of mine trying to understand how an Indian robo-advisor were benefiting and effectively sometimes harming investors. And then I have this project. And the entire research agenda, though, is trying to understand the ultimate economic questions we're after is trying to understand how much complementarity and substitutability there is between men and machines when it comes to financial advice, and also, and more deeply, what do investors really care about when it comes to financial advice? So what are the tasks that we can delegate to a robot, and what instead are the tasks that we have to maintain for the human? Okay, so today's presentation, I'm going to talk to you about a study I'm conducting with Vanguard. We're going to study the effect of Vanguard personal advisory services. And this is the largest hybrid robo-advisor in the world. Hybrid because it doesn't only have a robo component, but it also has a human component. It has $120 billion of investments under management. It has experienced an explosive growth since inception. And today's presentation is going to be extremely simple. I'm going to tell you what are the effects of robo-advising on the investor's portfolio, and then I'm going to tell you who are the investors that benefit the most and which ones instead benefit the least from adopting this tool. Before giving you all the results, let me just give you in one slide exactly how this robo-advisor works. If you were an investor, you can go on the website. You can create your own profile where you put in your financial objectives, your risk tolerance, your demographic characteristics. Then the algorithm is going to create for you a comprehensive financial plan, which is going to include cash flow forecasts, the probability of financing a secure retirement, and also more importantly, a recommended portfolio strategy. And it's crucial for the implementation of the robo-advisor. Before signing up for the product, you have to talk to a human financial advisor that is going to explain to you what the plan is and how it's going to be implemented. If you decide to sign up, then your portfolio is going to be handled automatically by an algorithm and is going to be doing quarterly rebalances. Now, the data is going to be extremely simple. We're going to have 350,000 investors that interacted with the platform at some point. Not all of them signed up. We have the trades, we have the monthly positions, and we have not only demographic characteristics, but we also have all the characteristics about the stocks and the mutual fund and the ETFs that these investors hold. In terms of, just to give you a sense of what kind of demographics we're dealing with, we have individuals that are on average 63 years old. They are 53% of them are males, and the 40% of them are married. And in terms of tenure at Vanguard, they have been approximately with the firm for approximately 14 years. In terms of portfolio characteristics, they have $600,000 in assets under management, all distributed across 8 assets. Their equity to bond and cash ratio is approximately 54, 25, and 20%. And in terms of investment vehicle, we have that 72% of these investors are invested in mutual funds. The 20% of their wealth is invested in cash, which comprises money market mutual funds. And then a very, very small fraction of these investors are instead invested in stocks and ETFs. In terms of the type of mutual funds invested, we have that 50% are in index funds, Very few of them have international diversification, and we have that on average the fees paid by these investors are 14 basis points per year. Now, what happens to these investment portfolios as soon as they sign up for this service? I'm going to show you how all these characteristics are going to vary over time from the time of adoption. I'm going to start with cash. Effectively, money market mutual funds are going to be driven to zero. We're then going to have that all the wealth that is taken away from cash is going to be invested in bonds. And most of the wealth is actually invested into mutual funds. So we go from approximately 80% to 95% of wealth in mutual funds. The percentage of wealth in stocks that was already very small is driven to zero. And the degree of indexation, so how much of the wealth is in passive index mutual funds, goes from 50% all the way to almost 85%. And one big advantage of this Robo-Advisor is actually giving a huge amount of international diversification to these investors. And finally, also as a product of going from active mutual funds to passive mutual funds, we have that the fees paid decrease from 12 basis points all the way to 7 basis points. Now, all these univariate plots are potentially misleading just because they average across a huge heterogeneity across all the individuals that we have in the sample. And this is, just to give you an example, obviously if I take equity share, you're going to see that there is very little change in equity share before and after signing up for the product. But if I were to condition the results on those investors that had very little wealth in equity and a lot of instead wealth in equities, you would see that the heterogeneity would be very large, right? So we have that those investors that had less than 10% of wealth in equity have their portfolio all the way to 45%, and the opposite we see for instead those investors that are 100% in equities at the time of sign up. And this is kind of motivating the next part of the presentation, which is exactly trying to understand who benefits from subscribing to this robo-advising. And we're going to focus on two measures. The first is going to be the changes in portfolio allocation, and the second one is going to be the changes in investment performance. And what we're going to do here is not going to be very clear ex ante what is going to be the factors that are going to be related to a particular the changes in performance after adopting the robo-advisor. So instead of having a baseline linear regression model, we're going to use a booster regression tree model, which is nothing else but a machine learning tool that is going to allow us to tell which factors matter and what is the non-parametric relation between the variables that we want to explain and each variable averaging out or integrating out the effect of all the other variables. So in the first exercise, we're going to focus on portfolio changes, and we're going to have as covariates the demographic characteristics, the portfolio characteristics, and the trading characteristics I showed you in the previous slide. And no surprise, what we find is that if we want to explain how much the robo-advisor is going to change the proportion of equity that investors held, the variable that matters the most in explaining this changes is the equity share that the investors had when they signed up for the project, for the product. So for example, those investors that had 0% of their wealth in equities have an increase of their wealth in equities by 30%, and instead those investors that had 100% of wealth in equities have a decrease of their wealth in equities by 30%. And those instead that were signing up with 60-40, they don't see that much of a change. On the other hand, what we see is that age also has a big impact in the sense that those investors, the younger ones tend on average to have their exposure to equities increased at time of sign up, and the opposite happens instead for the more senior clients. When it comes to understanding how much robo-advising affects investor performance, here we have a rather short sample, but what we can do is we can compute the realized Sharpe ratio of each investor's portfolio and compare it to the realized Sharpe ratio of the market portfolio, so the US market portfolio. What we find is that after signing up for the product or after signing up for robo-advising, investors have a better risk-adjusted performance or risk-return trade-off compared to before, and they actually outperform the market. And we can do it for all our accounts, or we can also work only for those accounts that were present for 3 or 9 months after signing up for the product. And instead of showing you numbers, let me just show you a graph. Here what I have is the density of the abnormal Sharpe ratios before and after signing up for the product. And in principle, if the Robo-Advisor didn't have any effect, you would expect that this density would be centered at 0. You would have some individuals on the right hand and some people on the left tail. But what we actually find is that the average is positive, and the density is really moved to the right, indicating that the majority of people are actually benefiting from the product. But obviously, what we want to do is to go a little bit deeper here, and we want to see who are the customers in the tails, which customers are in the right tail of distribution, which customers are in the left tail of distribution. So we're going to use exactly the same procedure I showed you before, but we're going to have as a target variable now the change in risk-adjusted performance. And what we find is that there is a negative relation between tenure of these individuals and how much they improve, indicating that those people that had already a much longer tenure at Vanguard are the ones that actually benefit less from signing up for the product. You have that those investors that had a higher proportion of cash benefit the most, and those investors that had a higher fraction of mutual fund don't benefit as much. When it comes to trading volume and indexation, we have the same. Those investors that were trading a lot before signing up for robo-advising benefit a lot, and those instead that were already in index mutual funds are the ones where we see less of an improvement. Okay, so I'm often asked, why do I think that this robo-advisor in particular was performing reasonably well? Well, I mean, like, in principle, the robo-advisor in itself is very simple, right? It places investors on a few index mutual funds that are very cheap, so it effectively is nothing else but the recommendation that professor of finance would give individual investors. There is another element. The fact that there is a human component doesn't allow investors to trade on a whim. So we know that what happens in many situations that investors tend to trade when they get scared, when market volatility increases, and because of that, they tend to get out of the market exactly when the expected return on the market is very high. But this is something that is prevented by the fact that they have to interact with a human. And obviously, the fact that the large market share is mainly due to the fact that the company itself had already a very large number of customers. And the hybrid structure is really designed in such a way that, from the customer perspective, they actually feel that they have contact with a human. But they feel they get exactly the same service they would get from a human advisor, but for a price that is basically a tenth, because usually a financial advisor would charge 2% per year. They charge 25 basis points per year or 30 basis points per year. And this brings me to the last 2 slides, where I just want to leave you with some kind of open questions and challenges regarding robo-advising. What I think is going to be the crucial aspect for this industry is trying to understand how much human interaction do we need to have in the design of robo-advisors. We know that younger generations tend to be less algorithmic averse. So if you're targeting a younger group of individuals, you may want to have everything automatically done. At the same time, most of the wealth resides with the seniors, with the elderly, so you don't want to lose that opportunity. And one thing that is crucial is that humans tend to be pretty expensive, and so you may have the tendency to give a huge amount of customers to a single financial advisor. At the same time, in periods of high volatility or in crisis, it's going to be very hard for a human advisor to reach hundreds of customers on the same day. Okay, so very different players in this spectrum or in this area of the market are having different strategies. So you have incumbents like Vanguard and Fidelity that are going more on the hybrid structure. On the other hand, you have new entrants like Wealthfront or Betterment that instead are really going all robo. Another crucial element or a crucial challenge for this industry is going to trying to communicate value to investors. In many cases, you have that if everything goes well, the robo-advisor is not going to be trading that much. So you're not going to see that much activity. But in many cases, the perception of value and trading go hand in hand from the customer perspective. So communicating value is a big challenge. And I think that this explosion of robo-advisor is going to be crucial. It's going to be crucial for us to really understand what aspects in financial advice are crucial to the customers, what are the things that can be done by a robot, and what instead has to be done by a human. And finally, I think one of the aspects that is often talked about is tax loss harvesting. This is something that everybody talks about, but I've never seen a convincing study showing exactly how it is done and how effective it is. Thank you so much.